there will be a lot of changes that will happen globally. How our accounting standards board and the institute make those changes, or the MCA through the notification make those changes, needs to be seen. But essentially the CFOs need to be prepared that you're not dealing in a static environment where accounting standards changed only once in 3 years or 4 years. Accounting standards will evolve over a period of time depending upon how globally these transactions are viewed. I think the second aspect really is Ind-AS is all about disclosures. It's how you communicate your financial reporting with your stakeholders becomes a very important benchmark. I think the focus will move from reporting numbers to reporting events. I think that's where I see a significant change. Today, the disclosure is very number heavy. So you have the Schedule 3 disclosure, which talks about all disclosures within, for example, debtors, to disclose what is above 6 months, less than 6 months, disclose what is the provision for doubtful debts, etc. Or within expenses, you disclose line items on expenses. Very number focused. Writing of events. So, for example, how a post balance sheet event needs to be communicated was not so well sort of defined. Whenever you're moving to an Ind-AS, you are making your financial statements comparable with the best in the world, right? Therefore, what is different between the best in the world and number focus is this communication aspect. How you communicate your contingent liabilities, how do you communicate your event, how do you communicate what are the judgments and estimates that you've used in the financial statements by preparing those financial statements, right? Those important elements will start becoming part of active communication by the CFOs in that. So that's a very important shift. So I, as an investor, for example, or a shareholder, will not just focus on numbers, but also how those numbers are making sense in the financial statements. So there is a whole list of disclosures around IFRS 7 or Ind-AS 107, which is basically whenever I have a typical kind of financial instruments, I have loans, I have investments, how are those getting valued? Those are important disclosures for me as an investor to know that are there any elements of risk which have been factored in or not factored in. There is also a disclosure about sensitivity of foreign exchange, which was never there earlier, right? So if a dollar, I have a high exposure of dollar, how would a dollar movement impact my earnings? How would that be factored in the financial instruments that are being carried in the financial statement? Those are important disclosures which certainly will come on the balance sheet. And therefore, as a shareholder, I'll probably get to know a little more of the risks that the business carries. Under the new rules, the new consolidation rules will go beyond these two rules to say that if there is an economic control of an entity, you would essentially consolidate the entity even if you had 0 board seat or you had a 0 equity interest in that company. Now, which will mean is that most of these structures will have to collapse into a consolidation mode. The way you do business, the way you therefore construct your agreements between the two corporations will change. Like real estate companies are very known for joint development arrangements where, for example, 2 or 3 companies come together to develop a new commercial property or a residential property. The accounting norms of that will also change. The revenue recognition under Ind-AS is not materially different from what was already there under Indian GAAP. And I think except if you were to look at infrastructure companies where some of the revenue recognition principles will change because of the introduction of 2 standards, and I will give those highlights. There is a concept of embedded lease wherein, for example, an automotive company, right, component companies sets up line for the OEM under an OEM arrangement. Now, that line, if it is effectively guaranteeing the entire economic benefit of that line to a particular customer, right, with certain conditions, the entire line will move out of the books of the manufacturer to the customer's books, right, which will mean that the revenue that you're recognizing will have to be split between what you do as a leasing revenue of leasing an asset, and the second is what you do as a servicing of that asset, which is basically producing components and supplying those components to the customer. But if you look at broadly, there is no conceptual significant change for a normal revenue recognition. Revenue recognition will still be as per the, once you transfer the risks and rewards and you don't have control over the goods or the services. I think that's where principle broadly remain the same, but there are finer lines of gross versus net, finer lines of how do you define a particular discount being given, whether you record it as a net or you record it as a gross of revenues. How do you deal with the situation where you have embedded leases or as a concessionaire arrangement? Those are finer details that have come up, in the revenue recognition guidelines. When IFRS 15 gets adopted globally, which is going to be happening somewhere around 1st of January 2018 onwards. So for Indian companies, if they meet the timelines, it's going to be March 19 onwards. So April 1, 18 onwards is when essentially you start reporting under the new standard. Now that new standard, I think, has principally moved away from the risk reward model to a primary obligor and obligation model. If you and I have a contract where I commit myself to providing you 4 or 5 services, obligations, only when those obligations are met can I record revenue. So that, I think, is a fundamental shift from the current standards. That's going to come only about 2 years from now. So therefore, the CFOs have to be now more proactive, work with their business people, with their business presidents and other people in their organizations to preempt some of these things and participate in the decision making. Because at the end of the day, as I said, because it's all about business being reflected in the financial statements, the owners of the business, the shareholders of the business, the stakeholders of the business would like to see how the transactions ultimately getting executed and reflected. So therefore, it is also for the CFOs, or the preparers of the financial statements, to make sure that they get involved at the right stage, and then the entire transaction is well thought through and seen through in the financial statements.